Welcome everyone to tonight's public lecture, Risk and Rewards in Credit Markets by Professor Antje Berndt. So before we begin, I'd just like to acknowledge and celebrate the first Australians on whose traditional lands we meet and pay our respects to the elders of the Ngunnawal people past and present. And before I give a brief introduction to Antje, I'd just like to say that it's really great when I looked at the list of people who had RSVP to this event that there was a large number of our students. I think as a college and as a school, we try really hard to create a good educational experience for students, and I think part of that's what you learn in the classroom, but I think it's important that you make yourself, you value yourself of the opportunities that the ANU offers, so public lectures like this. And also I think, in a degree, obviously you learn stuff in the classroom, but I think what you learn from your contemporaries is just as important, if not more important. So after this event there will be canapes and drinks, so I'd encourage you to stay around and mix with other students, mix with our guests from the public service, our former graduates. I think that's a really great opportunity that you should take advantage of. So just a little bit about Antje. So I'm assuming everyone's read her bio and her qualifications and things, but just a bit of a background from the school's perspective. So hiring senior academics in finance is very difficult. I think in the academic context it's almost the hardest people to recruit, particularly getting excellent people from North America or Europe. So when we're able to recruit Antje from North America, it was a real coup for us. So Antje's obviously got a fantastic background. After studies in Germany, she did a master's at Columbia and then a PhD at Stanford with Darryl Duffy, and then moved on to positions at Cornell, Columbia and NC State. So a fantastic pedigree. And just in the short time that Antje's been with us, we've noticed her input's been fantastic. She's already taken up an associate director position of research within the school, and we've just noticed that her experience has really added to the research environment and the mentoring of our junior academics. So just one other note before we get started. So the Dean of the College, Ian Clark, is at the Senior Management Group meeting, so he'll be here shortly and he'll sort of run the questions and then give his concluding remarks before then. So I guess that's all I'll say for the moment, but as I said, please stay around after the lecture. In addition to Antje, there's other well-known academics from the college that are here, so please join me in welcoming Antje. Thank you.
Thank you very much. Can you hear me all right? Yeah? All right, thank you so much for giving me the opportunity to talk about my research and introduce you a little bit to what I'm thinking about when I sit up there in my office. So most of the time I work on aspects related to asset pricing, both theoretical and empirical, and within that area I focus most of my applications on fixed income markets. Fixed income markets are the sort of plain vanilla products there. Corporate bonds. And corporate bonds, when you invest in them, you face a number of risks. One of them is, of course, market risk. How will interest rates move in the future, right? That certainly, if they go up, your bond loses in value. If they go down, bond prices go up. Of course, we understand this. We have studied that in the government bond market. But if you think about investing in corporate debt, there's another source of risk that you are encountering as an investor, and that is credit risk. Credit risk is the notion that there's always a chance that a corporation you lend money to may not honor its repayment schedule, right? They may not repay on time, they may not repay in full. And the uncertainty involving whether or not they repay in full and on time, that is what we refer to as credit risk. So if you are an investor, institutional retail investor, what do you do if you're worried about credit risk? Well, you could avoid corporates at all, right? You could just stay away from them, but then you cut off a whole asset class. You don't want to do that. In the name of diversification, right, you want to be able to correctly put a value on corporate debt and be able to invest in them. So what else could you do? Well, let's say you're Bank of America, right? And you have long-established client relationships, let's say, with American Airlines, right? I just moved from the States, so my examples are still US heavy. But let's just take those two firms, right? So you, as Bank of America, have a large chunk of, or a large portion of American Airlines debt sitting on your balance sheet. And then it's 2011, and you hear chatter about American Airlines, which so far is the only legacy airline that has not gone into bankruptcy, being closed or on the brink of default. Okay, so you get nervous about that debt sitting on your balance sheet. So you have two options. You can sell it, right? But if you physically transfer ownership of the American Airlines debt to someone else, AA will know about that. And they may hold that against you in the future. So it would be really cool if you could transfer just the credit risk portion that you're worried about it and that are associated with these AA bonds. And this was one of the main motivations of the establishment of the credit default swap market in the late 90s or mid to late 90s. Credit default swaps are derivative securities that basically enable institutions like Bank of America to transfer just the credit risk portion of their investment in American Airlines. And how this used to work is that people on the credit desk at Bank of America would call up the guys they know at Citi and Deutsche and UBS and ask, would you insure us against default of American Airlines? And if someone at Goldman would decide, okay, we are short airline risk, we are underinvested in the airline sector, they may be willing to do so. And if there is an agreement that Goldman will protect against default American Airlines and Bank of America wants to buy that protection, well, then the only thing left to do is to agree on a price at which this insurance is bought, right? And so the way credit default swaps, the contract that is going to settle this transfer of risk is structured is basically that Bank of America agrees to make quarterly payments to Goldman Sachs, right? And they make these payments usually for a duration of 5 years or until American Airlines goes bankrupt, whichever event occurs first, right? Should American Airlines go bankrupt, and they did file late in 2011 for Chapter 11 protection, at that point, Bank of America stops its payments, its insurance payments, and in exchange, Goldman will cover the difference between the notional of the debt that sits off Bank of America's balance sheet, the notional of the AA debt, and its current market value. Okay, so you will be covered up to notional of the debt, no matter what AA trades at this point. So one of the most sort of drastic situations where credit default swaps came in place in recent memory is a default like American Airlines or Lehman Brothers. We all remember that in 2008, right? If you were uninsured, long Lehman debt at the time it collapsed in 2008 in September, you would only have recovered 9 cents on a dollar notional at that point, right? You would have had a loss of over 90% incurred. But if you had bought protection for a credit default swap, you would have been okay. Your counterparty to that CDS contract would have incurred the loss, okay? So what I'm interested in a lot of my study is to understand, well, what is this insurance premium that Bank of America and Goldman agree on, right? What is the quarterly premium that Bank of America agrees to pay and that Goldman demands, right? How is it determined? How does it change across firms, across industries? How does it change across time, right? And so to get started, I'm just showing you a plot here. This is the last decade and a half, basically really since the beginning of data collection on credit default swaps. You see the median insurance premium annualized on these contracts, right? The median firm on which credit default swap trade in the States is a medium credit quality BBB firm, and the insurance premium runs from all the way below 50 basis points, 0.5%, to over 3% at the height of the crisis, right? So if you look at a graph like this, you notice a couple of things. Well, even at the median, this is what I'm showing here, right? The median firm, there's a lot of variation in the price of default insurance, right? It always spikes up when you have these drastic events like the WorldCom default in 2002, right? Then you have a little bit of a spike when Ford Motors and GM were downgraded in mid-2005. Then you have Bear Stearns bailout, right? Unseen levels after the Lehman default and Citigroup bailout in late 2008. Then a recovery, and then you see a couple of hiccups again, especially here with the European debt crisis and the debt ceiling negotiations in the States being prolonged, right? But there's a lot of economic information involved in a plot like this. If you look at the stock market and want to give people a general notion of how the stock market is doing, in the States you would show an index of the S&P 500, right? If you talk about stock options, you show in people a plot of the volatility index on the S&P 500, right? That's the pricing tool there. If you look at bond markets or credit markets, what people basically look like are plots like these, right? How does the pricing of default risk change over time? You either look at CDS index products or some market benchmarks, market medians or averages across time. All right, so those are the prices at an aggregate level. And if you think of the compensation investors demand for insuring against credit risk, well, what do they demand? Clearly, they expect, right, there's an expectation that that losses due to bankruptcy filings may occur, right? So historically, we can observe how often firms default, and if they default, what portion of notional creditors lose, right? In combination, that gives me an expected loss on the underlying debt. Clearly, before I insure someone, right, against such an event, I demand compensation for those expected losses, right? So definitely, part of this insurance premium that we observed in markets and that I showed you on the previous plot will be compensation for expected losses. But what I'm going to show you today is that this expected loss component is by far not the most important driver of these prices, right? There's a large portion of credit spreads that investors demand above and beyond these expected losses, right? Why may they demand extra compensation? Well, even if I had the best historical prediction model for the arrival of credit events, right? Even if I do everything right statistically, I don't know that the past is going to repeat itself, right? I'm still uncertain about what will happen in the future. So to compensate for this uncertainty, I require credit risk premium. There's also a notion that at times of market stress, liquidity in CDS trading may freeze up. So I may require compensation for liquidity risk. I may put a premium on liquidity risk, right? All these things, other notions of market friction, they may all contribute to a deviation of the observed prices and expected losses. And for now, I'm just going to call that credit market premium. And I want to measure how big it is, right? How it changes in the cross-section, how it changes over time. All right, so formal definition of the expected loss component is that is the CDS spread, the insurance premium that I would charge as an investor if credit markets were completely frictionless, arbitrage-free, and if investors were risk neutral, right? In such a model world, that would be the price charged. Those are the deviation between observed prices and expected losses. All right, so I'm not going to go through all of, yeah?
All of these are bilateral contracts?
Yeah, they used to be just over the counter, but now at least a fair number, even of the single name CDS, are traded through a centralized clearing institution, right? But in the 90s, early 2000s, you would really just call someone up and make a over-the-counter bilateral agreement. There was very little transparency that related or explained a lot of the liquidity freeze up in the market during the financial crisis. And since then, CDS markets have gone a long way in terms of centralization, central trading, and increasing transparency. Yeah. All right, so here, this is the focus point, so keep this in mind. I want to measure the expected loss component of observed prices in credit markets. And to do that, well, I have to think about what I'm pricing in credit markets, so I have to come up with a formula for these expected losses. And what is going on in this slide is, first equation is a formula that basically equates the expected payments on the left-hand side by the buyer of protection. So that delta is my time interval between payments, a quarter. C is the at-market CDS spread. M is my pricing kernel, right? And D is an indicator for default events. So the left-hand side of the first equation says, as Bank of America buyer of protection, you have to pay this annualized CDS rate, C, every quarter, C over 4, until default occurs. Okay? That's the left-hand side. And I set that equal on the right-hand side with the expected payment from Goldman, who pays nothing unless there is default, right? The default indicator kicks in, D on the right-hand side. And at default, you pay whatever the difference between notional on the debt and the recovery value is. That L is loss given default, right? If I set these two equal and solve for the insurance premium C, that makes it first equation equal. That is my at-market credit spread, okay? That applies if markets are frictionless and arbitrage-free, right? That's not, and now I want to figure out what of that C is expected losses, and then I need to basically solve that first equation, but under the assumption that investors are risk neutral, right? So I've substituted credit spreads with expected losses, solve for them, and it's not a difficult formula, but it just involves a lot of computations of discounted expected future losses, right? And the reason that's all I have to do is if I assume risk neutrality, all these, up in the first formula, these expected values of products between the pricing kernel and the losses given default, they fall away. The expected values of those products, right, are usually just the products of the expectations, and you have to take care of the covariance terms, but the co-movement between the pricing kernel and the default event and the loss given default is assumed away under risk neutrality, so I can solve this really easily, right? You can think of this expected loss, which is a bit convoluted here, as basically expected loss rate, loss given default times expected default frequency. That's what it really is, right, under the physical or historical measure. And then I'm showing you the same plot from before. So that top line that moves around is really the same median CDS spread as before. I just filled in the area under blue, and the reason I did this, I then want to highlight that fraction of the total compensation for risk that investors get in credit markets that is due to expected losses. And I hope you can see this, it is this red shaded area here. And you see how that is, well, it's around 25%, right? It is not 70%, it's not 80%, it's not most of it, it's just around a quarter of the total compensation, right? And there's also not all that much movement in these expected losses over time, at least not compared to what you see in the prices themselves. And now I take that same measurement for expected losses that I computed, and what I express here now, look, this is now the price for buying default insurance, C, right, my premium, default insurance premium, per unit of risk to be insured, right? So credit spread per unit of expected loss risk to be insured. And you see that this ratio, CDS to expected losses, changes widely over time, right? It can be as low as just a 2-to-1 ratio. Half of the CDS is expected loss compensation, half of it is risk premium, That's what we had in this really quiet period from 2003 to 2005. During the crisis, that ratio was bigger than 10 to 1, right? So that is, those are sort of the measurements I get out of my expected loss computation. And then I want to understand, all right, so now I know how big credit market premia are. I know what compensation above and beyond expected losses investors demand in credit markets. All right. And now I want to build, at least in this part of my research, a prediction model, right? And why is it, why is it not the end of the story if I know what expected losses are and everything else are credit market premium? Well, the rest may correlate, right, with expected losses themselves. At times when losses go up in expectation, premium may be higher or lower, right? So the first thing I ask myself, once I did this decomposition, I sort of look at a different challenge and I look at, all right, how much, can the movement across firms and over time in expected losses explain of the movement in credit spreads, right? And then I've done this over many years now, this plot, and the dispersion just keeps getting wider, right? So the plot is no good if you plot CDS versus expected losses. There's just a lot of heteroscedasticity. I mean, the sort of the dispersion grows as risk grows on the x-axis. So you take the logarithm of both credit spreads and expected losses, and you have something that looks fairly linear, right? If risk goes up, compensation demanded in credit markets go up. When I did this plot in 2004 with data of 2001 to 2004, that red line had an R-square of over 70%. When I do it now, with all the data out to 2015, that red line, right, a simple OLS regression, only has an R-square of 26%, right? So yes, expected losses are highly, correlated economically, statistically with the price that investors demand for default protection, but they don't explain everything, right? Not even not as a proportion, and also not in terms of variation. So I asked myself, all right, so how much more can I do? What else can I explain? And so just to get a feeling of how far can I drive up this coefficient of determination here, R squared, I allow first for just firm fixed effects. That shoots up from 26 to over 60% R squared. And then I also allow for just monthly fixed effects, and I get up to almost 84% R squared. All right, so there's a lot of work left to do for me, right? If nothing else would happen, plus credit spread would all just be noise, but there's a lot to be explained. And expected losses, even though 10 years ago got me very far, nowadays they don't get me far at all, right? So I need to explain, or the challenge is to find firm characteristics that capture this, and macro variables that help me explain the movement over time, all right? So first I look at my firm dummy multipliers that come out of this log-log regression, and the first thing you always do when you do a credit market study is you group it into firms based on credit ratings, right? And sure enough, even though I have already controlled, right, for expected losses, for expected risk, if I group the unexplained variation by the credit quality of the firm, I see a very, very strong increase in CDS spreads as credit quality worsens, okay? And so basically just controlling for credit ratings, and we do a little better than just putting in a letter of rating for Moody's. what we do when I say refined ratings, we take Moody's alphanumeric rating, so we have 21 categories, and then we adjust it, just to make it a bit more informative, we adjust it every time there is a movement on the watch list and outlook table or status of the firm, right? So if there's good news, just by putting the firm on a positive outlook or positive watch list, you improve the notches of the credit rating already, and vice versa for negative news. So these refined ratings become quite informative, and you see that the price of risk per unit of risk to be insured scales with the credit rating quite dramatically. So why is that? Is my measure of expected losses not good? I mean, credit ratings should give me a notion of default risk, and my expected losses, which I compute based on Moody's expected default frequency, which is a firm-specific day-by-day estimate of default frequency, should capture all the information in credit risk, right? So why is there still this dependency on rating? And we think this has a lot to do with just essentially the investor base shrinking as you move down the rating scale, right? A lot of us feel comfortable investing in investment grade debt, right? You have institutional investors, you have retail investors, right? Mutual funds, pension funds, a broad investor base. As you move from investment grade to high yield debt, you get more and more a shift more and more towards institutional investors only, and companies that focus on distressed debt investing, right? So you shrink the capital that is available to provide protection against high yield firms when you compare it to investment grade firms, right? And so that shifts supply and demand for risk protection, and that makes high yield debt protection proportionally more expensive. All right?
Sure.
Yeah?
You calculate expected loss in terms of Moody's.
Using Moody's expected default frequencies.
Not exposed losses?
Well, I need both, right? Expected losses has a probability for the arrival intensity of an event, and then based on default, I need an estimate for loss given default. So I take the Moody's EDF measure and multiply this in either very simple or more fancy way with expected loss estimates. Market provides estimates on recovery rates. I have estimates for recoveries based on sectors, based on ratings, but honestly, most of the movement you see in expected losses comes from the default frequencies. Expected loss rates are always around 60%, right? There's very little heterogeneity in the data that you can get. They change a little, and we do what we can, and we do a lot of robustness checks, but
this is firm level?
the recovery rate data from market is, yeah, it's firm level and day level. There's just not much movement in those numbers provided. Yeah. All right? Okay, so that is the cross section. And the other thing I wanted today, so to say, look, if you control, in addition to expected loss rates for these refined credit ratings, and then we also control for idiosyncratic, firm-specific, put-implied volatility for out-of-the-money put options, all right? And for sector and clientele effects. So what I mean by there, I want to catch some momentum in rating sensitivities. I want to catch the movement that when a firm has recently been downgraded, it seems to be on a downward trend, right? And you see this in the credit spread pricing and vice versa. You also see an extra effect if people fall out of investment grade status into high yield. The most interesting variable, though, that I think we add to this is this out of the money put implied volatility. And what that gives you is the following. When you compute expected losses, and any model that's based in some form or another on a structural framework, like the Merton model for default, Black-Scholes Merton model for default, right? You have sort of a fairly smooth process for the value of the assets of the firm, right? What you're not modeling or capturing in these expected loss estimates are sudden events, sudden jumps to default, either for firm-specific or market crash reasons, right? These are not captured in the EDFs or my expected default, expected loss estimate, but they should be priced in out-of-the-money put options, right? Put options that only kick in if the stock loses a large part of its value, right? And so that helps a lot. All right, so we have that, and with those variables, we basically get here, right? We get to 60%. And now we have the time variation to explain. Well, and if you look at this plot you you see what will help, right? So over time, these risk premia are the highest when market is in distress, right? This is the Great Recession. This is the 2001, 2002 credit crunch. So if I can capture this with my macro variables, I'm in business. And so what we're going to use is, right, interest rate level and slope helps. Out of the money market-wide implied volatility helps because it captures the pricing of economic catastrophe risk, all right? And then sort of, you know, you look and you try different macro variables, consumer confidence or the Michigan Index of Consumer Sentiment, where consumers are asked about their expectation or assessment of how the economy is doing. That is very helpful in capturing this timeline. The depth of the CDS market, meaning liquidity measures for CDS trading help. And so if I put in just those 1, 2, 3, 4 variables, I essentially get to here. So with the observable variables, I get explanatory power of over 80% for these credit spreads. There's quite a bit of noise still left over. The residual mean squared error is still close to 40%, right? This is a log-log model, but I'm doing as well as these uninformed proxies get me, right? All right, so that is that. And then I move on and say, all right, I've measured and now I've predicted credit market premia, what's left over in credit spreads after controlling for expected losses. And now I want to dig a little deeper. And so what I do in another study, I take that equation that I started out with on the first slide, and the second component, right, that premium component on the right-hand side, I decompose one more time. And I want to get at the heart of the matter of what of this premium, which seems to be the largest component of the credit spread, is compensation for credit risk premium, right? Compensation for uncertainty regarding those estimates of expected losses. And what is the rest? What is in a liquidity adjustment, right? And the reason I'm interested in separating this residual component or credit market premia is that whenever we model CDS spreads in reduced form in textbooks or in papers, what we always just assume implicitly is that the whole of the credit spread is just the sum of the expected losses and compensation for credit risk premium, that there's no liquidity, no market frictions playing a role in this market. And so I want to sort of have a checkup of to what extent this is true and whether or not this is a good assumption, right? And so
liquidity adjustments will be independent from statistically independent.
Not necessarily. So this is not a regression. I need to compute this component, the risk premium component for credit risk in as much of a model-free environment as possible, right? I have measured expected losses, and now as model-free as possible, I also want to measure credit risk premium. So don't confuse credit market premium, sort of the residual component in credit spreads after controlling for expected losses, with the premium that is just due to compensate for the risk of default and recovery risk, right? So I want to separate out what is compensation for default and recovery risk from that whole part in the credit spread that's left over, right? And so how do I do that? How do I do that? So what I basically did in the study is the credit risk premium is basically compensation, if you go back to my pricing formula, for the co-movement between loss rates and the arrival intensity of default together sort of mean loss rates with the pricing kernel in the economy, right? To what extent can I diversify away risk, and to what extent is it systematic, right? And cannot be diversified away and requires compensation, all right? So to compute this risk premium on credit, I have, in a more convoluted form, find estimates of this conditional co-movement between the pricing kernel and these loss rates. And so how do I do that? Well, there's no right or wrong pricing kernel. The assumption I have to make to compute this conditional covariation is what is the pricing kernel to which I want to benchmark this to in the economy, right? And so the only studies, right, where models for pricing, in finance, where models for pricing kernels are proposed and calibrated and discussed in a very advanced setting is the equity literature. So I go to equity markets and I say, look, I'm not saying that they are, but if bond and equity markets are integrated, right, then the stochastic discount factor or pricing kernel that prices equity should also price credit risk, right? So start with that assumption. Take the pricing kernel that I know works at least to a certain degree, as good as it gets in equity markets. So I take the external Herbert model from Campbell and Cochran, and I also look at Bansal-Yaron's long-run risk model, and I basically use their model specification of a stochastic discount factor pricing kernel in the economy. I calibrate it to data, do a lot of robustness checks on this calibration, and compute conditional co-movement between those equity-based pricing kernels and losses observed in bond markets. And what I get is that this risk premium component, so I have different specification of the external Herbert model from Campbell and Cochran. The best one, if I want to believe this, right, tells me that the co-movement between a pricing kernel and realized default in the economy accounts for less than 20% of the CDS spreads, right? The most I get, and believe me, I tried really hard, because I was trained at Stanford in this reduced form model setting, and so I want reduced form models of credit risk to work based on history, but you can't get them to work, right? So the honest answer is, right, we've always been, people like me have been criticizing structural models. I mean, everyone knows that structural models of credit risk that come out of the Black-Scholes-Merton literature fail when it comes to explain the observed level of credit spreads and bond yield spreads, especially for investment grade debt. And then we always said, that's why you should use, or that's why we will use a reduced form model. And so what I did in one of my recent papers is I said, well, is that really possible to get all the way there in reduced form models? And it's not. Even in the best of circumstances, you get barely to 50% of the observed credit spread if you take the interpretation of expected losses and risk premia seriously. Now you can criticize me and say, well, but markets may not be integrated. And I say, okay, right? If they are not, right, you may interpret this as they are not. So then we have to learn more about potential pricing kernels that price bounds. Why are the market not integrated? Why would investors segregate themselves to that extent?
Equity risk premium, it's of a different nature from default risk premium.
In what way?
Oh, with default risk premium, you're worried about default, which are events that occur once. While equity risk premium takes into account the fluctuation in the equity.
Yeah, but when I compute the prices, you're correct. When I look at these co-movements, I need to correlate with whatever I think drives my pricing kernel, like consumption growth, right? With actual default events. And you're actually putting your finger right on it. That is just not that big, that correlation, right? Yes, with equity price movement, it is there to a much larger extent. But if you insist on the firm actually filing, you don't find it. You find it a little bit more for riskier firms. I get close to 30%. Because if something happens in the economy, those are the first to really be driven out, right? But for investment grade debt, yes, they may be downgraded, right? They may lose in value, but the actual default event, if it happens later, right? After consumption growth has tanked. So these equity, you're actually putting your finger right on the spot, these equity-based pricing kernels, right? They're ill-equipped to tell me, you know, what's going on in credit, if you want to interpret that way, right? But then you need to give up on the notion that there's one pricing kernel for both markets. One and the same, right?
That's fine, even if it's integrated, we are enough.
All right. So I will tell you a little bit more what else I work on. So I'm clearly very, you know, excited about research in credit markets, but I'm also, you know, curious, of course, of other developments in our discipline. And so very recently, I started thinking about the fintech market, in particular robo-advisors. This is with a co-author of mine, Shevin from Carnegie, and Hongling Yu, who's a postdoc here with us. I think about not just the sell side, but also the buy side of fixed income markets. So I look at the market for not just investing in, but borrowing corporate debt. This is with my postdoc, Yishao Xu. And I also have done some recent research on hedge fund activism. So just maybe if I could have those 5 minutes, I'll tell you a little bit about the issues that are occupying my brain during the day. All right, so robo-advisors and fintech in more general. Just what is going on in financial markets is at the moment that the most sort of innovation takes place at the intersection of finance and technology. So people have finally come to the realization that a lot of the financial management and wealth management and advisory function that used to take place person to person could actually be programmed up and offered online. And so one of the markets that sits within this broader area of financial technology is fintech pushing forward is that of online wealth management or online financial advisory services. And the name for that is robo-advisor. And so I'm currently, with my co-authors, trying to come up with a good framework that describes in a realistic setting how that market can be modeled. Who are the players? Well, it's the robo, right? It's the robo-advisor. The firm Betterman was the first, who at the height of the financial crisis offered the first online financial advisor platform in the States. In Australia, it was StockSpot. I don't know if you heard about that. And since then, a lot more of these robo-advisors have emerged, and there are now over 100 of them offering their services. So there is a platform sitting in the middle of the interaction between clients that have money to invest and look for advice on how to invest their money, and basically the financial markets that offer a wide range of investment opportunity, right? And the financial platform, the robo-advisor sitting in the middle, is basically asking clients to describe their risk appetite, their financial situation, and then comes up with a recommendation of how to invest their money, right? And this is all done with as little human intervention as possible with these robo-advisors. And a lot of the model building that goes into the platform, of course, has to mine big data, both from financial markets and in terms of matching clients' answers to questionnaires to portfolios, and then reevaluating this match over time by asking clients for their feedback on how happy they were with the outcome, right? And so we want to think of basically writing down a realistic model for firm entry and exit to this market and competition in the robo-advisor market. And if you look at this market, right, Betterment was the first firm, and it has grown. Here it's on top of the bulk at the bottom, but it has been completely overtaken together with the other startup robo-advisors by traditional wealth management firms as soon as they started their in-house trading platforms, Vanguard, Charles Schwab, right? And so unregulated, the robo-advisor market would basically most certainly end up with one or very few dominant firms again. And to prevent this, or to think about the benefits of having competition in that market, there's a lot of demand for, discussing intelligently and informed the potential impact of policy interventions, right? And policy maybe with regard of making sure that everyone benefits from these robo-advisors. The big deal with robo-advisors is since they cut out the human interaction, they can provide these services cheaper, right? If you provide management and advisory services cheaper, you provide access to these services for a wider range of investors, low-income families, the younger generation, right? And so that is a good thing, and if as a regulator you want to make sure that stays in this way, you want to make or ensure that there's sufficient competition in the years to come in that market, right? And that is one setup basically we are worried about, and I think I better stop here and not talk about the other two items on my agenda to allow time for questions. But I want to take a minute, and I do want to thank CBE, and in particular RSFAS and its leadership, Stephen and Steve here, for welcoming me really very, very warmly to ANU. It has been an easy transition, and I'm super psyched to be here. I'm thankful to my collaborators, of course. It's good to work with people and be able to exchange ideas, and I'm always open to explore new collaborations, talk about new ideas, new developments. So if you and my interests in the lab overlap, I'd be more than happy to talk. Thank you.
Before you all shoot off, thank you, Antje. That was fascinating. I'm going to say a vote of thanks in a few minutes, but there's an opportunity for maybe 3 or 4 questions. Anybody like to kick off? There is a mic, because the acoustics in here are not very good. Anybody want to ask anything? Somebody in the middle there, yeah. Just use the mic.
Hi, Andre. Isaac from FAS. So my question is, do you frequently observe default in the CDS market?
Frequently, Well, there are handful every year, but they're rare events, right? You never observe a firm that's currently AAA rated observe in the next year, right? There's maybe a 1% chance to observe a currently BBB rated medium credit quality firm to default over the next year. There's probably an 80% chance of a CCC rated firm to default in the next 5 years, right? So it depends on the current health of the firm and the time you give the firm to default.
The default I'm talking about is not the firm's default, it's the counterparty's default.
Counterparty risk.
Yes.
So people have tried this a lot to argue that plays a role in CDS prices. And even if you look at the height of the crisis, it only accounts for a few basis points in credit spreads. Maybe we don't have the right model, but from sort of the highly cited literature, the notion is, yes, it's statistically significant, but just not big enough on an economic scale to
So that's why when you do your regressions, you only do firms level, year level, but do not encounter the issuer's fixed effect.
Well, but I also don't know them, right? My data starts in 2001, and until that market became more regulated in 2009, on average, a single CDS transaction, right? I started my example with Bank of America and Goldman, but on average, right, Goldman would then net out its position by buying protection from JP Morgan on AA, and every of these CDS transactions historically was on average part of a chain of 17 offsetting transactions. Nobody knew, right, who was really ultimately exposed to the credit risk. And that basically led to the shutdown of the credit markets when Bear Stearns was near bankruptcy.
I think we better move on to another question. Is there one? Bruce.
So, son, I'm Bruce Chapman. I'm kind of from everywhere. You focus on and this is a question about the interpretation of the power of models. So you focus on the coefficient of determination, and you R squared, so it goes up from 23 or something to 60 and 80. It's not clear to me that they're better models with higher R squares, because we still don't. The economics of this is not all that obvious. You've got firm-specific effects, you've got monthly fixed effects, but we kind of don't know what they mean.
Well, but I do know what it means when I find that, say, the month-fixed effects to a large extent can be explained by the VIX index, right, or aggregate market volatility. I do know what that means, because then I say, even if I control for the firm's level of risk right now, if the risk to be insured and the uncertainty in the market right now is just much bigger than it is at some other time, and the firm has that same, let's say, 1% expected loss, right, then I know currently in the market there's a higher demand for default protection, right? And so prices go up, right? If the amount of risk capital available to serve that higher demand of default protection.
So you can test that without the fixed effects. You can just put that variable in, can't you?
But that's what I did.
Oh,
when I showed you that initial regression with the fixed effects and the monthly fixed effects, I only wanted to get a notion of how much the cross-sectional variation and time variation can capture.
Okay.
And then I go on. I didn't write down the model because, it's too long. But then I go on and basically told you on the next two slides what are those firm fixed effects,
Okay.
and what are the time effects.
With the simplest model, where your coefficient of determination is like 23%,
Yeah.
Did the coefficient on that change when you had the more complicated models? That's kind of pretty
It
interesting.
does.
That's kind of pretty interesting, don't you think? Because it means that when you're putting in the other things, the original simple model's not passing basic tests because the coefficient's moving around.
Yeah. Yes. You're right. Yeah.
Okay, good questions. Maybe I'm sure you'll want to continue that over a glass of wine, Bruce, maybe. Another question? Yeah, one more in the middle. Maybe one more after this. Let's keep it at 4, I think.
Sorry, this one's actually on the robo-advisors.
Okay.
You mentioned that the efficiency of robo-advisors will probably improve with client feedback, but at the same point, you mentioned that increased competition would be beneficial. On that sense, do you think a smaller number of robo-advisors would actually lead to greater efficiency from more centralised client feedback?
That is a good point, yeah. So there are certainly trade-offs. Yes, I mean, I think sort of the trouble, one of the issues that you observe in this market is this feedback effects, right? Sort of, you come to the market, you start collecting data, right? That data helps you to improve quality, right, at the same fee, right? That attracts more clients. That, you know, there's sort of this acceleration feature of data. So the early movers, or the people or the existing traditional firms that have, right, a wide client base already, should have an advantage in terms of benefiting from their data. And I think it's just, I mean, it's not clear what's socially better, right? If it comes to a monopoly or near monopoly, fine, but we don't want to end up in a situation that we're now, where people are getting charged, you know, 3 or 4% fees on assets under management versus the current 50 basis points that a robo-advisor offers, right? So it could be, right, one answer could be, well, let the best one win, right? But try to ensure by being transparent about pricing and benchmarks that you're not overpaying, or that the fees keep in check. But yeah, so I'm not pushing here. I mean, it's way too new, my involvement with this research, and I'm not pushing regulation. What we want to establish is a framework within which you can discuss and stress test the effects of all these policy interventions that are currently being proposed, right?
Okay, one last question if there is one. Nobody wants to ask the last question. Okay. Well, thank you very much. I just wanted to say a few words of thanks to Antje, and obviously thank you to all of you for coming at the end of a long day. I always think, as a dean of the college here, I always tend to think that inaugural lectures, which this is a bit like a graduation ceremony, and the thing they have in common is they are celebratory events. You know, we celebrate people graduating, we also celebrate really good people like Antje arriving and helping us to build the school. Judging by some of the questions, you wonder whether it is celebratory, but I think we all have good points to raise, and I'm sure some of those discussions will go on over a glass of wine. As a non-finance person, struggling to understand this stuff, I've actually learnt stuff. If I was in one of your classes, I'd be in the bottom quarter, I'd be in the bottom 5%, I'm absolutely sure. So I'm well beyond my comfort zone. But I thought, I knew before I came in really nothing about credit risk, Antje. So thank you for explaining things and making it accessible and understandable, and that's really, really important. And it comes from two things, that ability. It comes from really good teaching, and it comes from really good scholarship and the interplay between the research and the teaching as you get practiced at it, you know. And I think that polished understanding comes through and makes it accessible even to somebody like me. So I understand two things that I didn't when I came into the room. One is I understand the role of expected losses in credit risk, a little bit, but don't quiz me on it. And the other thing I know a little bit more about, where I was curious about, was this whole point about robo-advisors, which I'd never even
heard of, but we know a little bit more about that now. So a huge thanks to Antje for a really interesting talk and opening up to all of you and to us some of her fantastic expertise in this field, and at the end your research agenda. It's a shame we didn't have a little bit more time. So thank you again to you for coming. There are some drinks at the back, but I'd hope that you'd thank me thank the school in two respects. One is for the organisation of this event. They don't happen without real organisation. But a particular vote of thanks, and if you could join me in saying thank you to Antje for a fantastic lecture. Thank you very much.